Okay, hang on, we're going to go on a quick, about a 15-minute visual review of nonprofit financial statements. This is about accounting, so let's remind ourselves first what we're talking about when we're talking about accounting. We're talking first and foremost about the past, hence the picture. Sometimes accounting concepts are useful in considering the future, and we'll get to how and when accounting concepts are useful in the future later in the course. But the future, for the most part, is the realm of planning and budgeting, and we'll cover them later. Mostly, accounting is about the past. And it is about a particular aspect of the past. It's about the past from a financial point of view. Everything that can possibly be monetized is monetized. Now, sometimes that's easy. Sometimes the college has a petty cash drawer, let's say, and there's a dollar bill in there. We know what that's worth, since money is by definition monetized. It's worth $1. But what about that 3-year-old passenger van that the college owns? We bought it for $40,000 a few years back, but what's it worth now? And how should its value be reflected if our aim is to create a comprehensive view of the worth of an entire institution? And what if we took out a loan to buy that van? What is the amount that we should show not as a positive, as an asset, but as a negative, as a liability? Most of the time, financial statements cover 1 year. That's typically called a fiscal year, and it can occur in any 12-month period. Well, let's say our fiscal year runs from July 1 to June 30th. So we'll have financial statements prepared that will analyze finance for that 12-month period. But what do we mean when we say that? There are all kinds of ways to consider finance. It could be looking at a transaction. We get a tuition payment in, or we pay out a bill. Or it could be a way of establishing a value. How much cash did we have in the bank on the last day of the fiscal year? In all cases, accounting prescribes a set of rules for how to characterize whatever the financial activity is or the financial values are that we want to look at. As Berman and Knight point out, the rules may look hard and fast, but judgment is often required to come to the best possible conclusion. Maybe over a certain period of time, you get a bunch of checks for this and that. Tuition, room, board, research, grants, store sales. Well, the people in charge of handling the cash, they just cash the checks and they use the money to pay the bills. But the accountants live in a different world. They take their own look-see at all those checks coming in and they put them in separate pots. Now, they don't take the money and put the money in separate pots. That's the world of cash, and the people that handle the cash and the bills are doing that without any regard to how the accountants are thinking about how to characterize those transactions. But the accountants, they take those monies coming in and going out, and they, from accounting point of view, put them in separate pots. They put them in pots or buckets just for accounting purposes. The idea being that by putting them into those boxes or pots for accounting purposes, you'll get a better idea at the end of the year as to how things are going. Now, there are different sections to financial statements, and they do different things. We're going to focus on what I think the two most important sections of financial statements are. The first, Berman and Knight, you will recall, called balance sheets. They focus on what is owned by an institution versus what is owed as of a given date, typically the last day of the fiscal year, in our case, June 30th. As such, it is a snapshot of values at that particular point of time. Now, money things are in constant motion, but here in the balance sheet, we only want to take a picture as of that date. The second financial statement is what Berman and Knight call an income statement. It is very different from the balance sheet in that it is not static but dynamic. It's about money in motion. What happened over the course of a complete year, what money came in, what money went out, and in what bucket do we want to put them in. But first, let's have a quick sidebar on terminology. Berman and Knight write from the point of view of for-profit firms, and the accounting terminology for them is different than from governmental and nonprofit entities. Balance sheet and income statements, those are the terms that Berman and Knight use, are for-profit terms. But don't worry, each of these terms has a nonprofit counterpart that describes effectively the same basic things. So let's start with the first statement, the balance sheet. What is called a balance sheet in a for-profit context is called a statement of financial position in a nonprofit context. It's the same thing. Remember, first, that this is a snapshot as of a given point in time, June 30. As such, it doesn't look at individual transactions, payments coming in, checks going out, but is concerned with values. Everything needs to be valued. Again, that's easy for cash. We all know a dollar is worth a dollar, but as we'll see, it's not always that simple, and you have to estimate. So the game here is to compare what you own, these are called assets, with what you owe, these are called liabilities. Is it better to have more assets than liabilities? Sure, and most of the time you will. Well, let's go on and let's start with assets. All of our assets have to be valued and they have to be characterized under accounting rules. That means that when we establish a value for something as of June 30th, we need to put it into one pot or another. Well, what are those pots? Well, the easiest to understand is money. We can characterize things as being either currency or cash or something like that. We figure out the values as of June 30th, and more or less that's that. But there are more financial assets than that. The college may well have an endowment that owns stocks and bonds. Well, what were these worth at the close of business day on Wall Street on June 30th? You may have to consult the stock tables to figure out what they were worth on that day. You check it out, you write those numbers down, put them in the right pots. That's the value of your stocks and bonds. Well, but it can get funkier too. What about an IOU? Well, that's the unfancy name for what accountants call accounts receivable. Let's say on June 30th, on the day that we're going to be analyzing all this stuff, you are owed money by a student for an education semester that has already took place last year. Well, we want to count those revenues. They haven't come in yet, but we want to count them as assets in the current period because they relate to education provided in that period. So, this is what the accountants call the matching principle. We're going to return to that later. It's a really important idea. Look it up in Berman and Knight or in some other place. What you want to do is match revenues to the expenses in the time period that the expenses took place. So in this case, if a student owes you money on June 30th for education provided last semester, we're going to count that as an asset even though we don't have the cash in the bank quite yet. So that's it, right? We've now figured out our financial assets, your stocks, your bonds, your IOUs, what have you, and we're done. No, wait, there's more. Remember, we said we wanted to monetize everything that conceivably have a dollar fixed to it. So let's go back to, say, buildings. How should we be thinking about what a building is worth and how its value should be reflected? Equipment, computers, furniture, trucks, police cars, athletic equipment, the new and the old. Someone not only has to keep track of the equipment in real life to maintain it, but someone in accounting needs to keep track of how the values ought to be reflected and changed over time. So is that it? No, wait, there's more. Money is money. Investments are inherently financial, and buildings and equipment are at least tangible, but sometimes even intangible things need to be valued. Say a university researcher used a campus lab to develop a patent on a certain kind of turf grass. If and when someone in the outside world wants to use that grass, they may have to pay a license fee to the patent holder, and maybe the university is part owner of the patent because it was developed in the lab. In that case, the university might realize a flow of money over time. Well, that means that the accountants are going to say that patent, which is just sitting in a file someplace, is an asset. It has to be valued somehow. But how is it going to be valued? How much money is likely to come in from that patent? How much money is going to come in from all the patents that are sitting in the files? As you might imagine, this is exactly the kind of thing that Berman and I talk about when they talk about how accounting is as much art as it is science. Being able to value something as intangible as a series of patents sitting in a back file room someplace is a tough call, but it's a call that has to be made, and those things get written down as assets. So when you're done with all this counting, what you have is a big, big pile of assets with a precise dollar figure attached, but with a lot of estimates underneath that. So is that what the college is worth, the big pile of assets? No, because remember, the college owns things, but it also owes things. The value of its assets must be offset by the value of any liabilities. And so we must do at the end of the year a parallel exercise with liabilities as we just did with assets. We have to tally up all of the things that we owe and compare them to the things that we own. Let's say the college has taken out a loan to buy some equipment. Maybe that loan was originally $3 million, but $1 million has been paid off already. So write down $2 million, because $2 million is going to be the amount that's going to be reflected as a liability in the current fiscal period, because that's the amount that's outstanding on the loan. And the IOU game, that works the other way too. Remember we said that if a student owes the college money for last year's education at the end of the year, we consider it an asset. But flip it around the other way. Let's say on the last day of the fiscal year, the college has already received a shipment of books but hasn't yet made the payment. Well, we have the cash, but we really don't have the cash because that's expected to go out the door to pay for an asset that we acquired last year. So that's going to be considered a liability in the current year, even though we haven't made the payment yet. That's called accounts payable. Well, there are a lot of other liabilities, but that gives you an idea of what the concept is. So once we tally up liabilities, we're in a position to compare them with assets. And the statement of financial position does this in a very simple way, as follows. Assets minus liabilities equals what is called net assets. All that means is that when you own more than what you owe, which is what you aim for, the net, or the difference, is in a sense what you own, free and clear of any obligations to anybody else. In the business world, this is what's called owner's equity. It represents the free and clear ownership of the firm. But remember, we're not in a for-profit world here. We're looking at nonprofit and governmental accounting. And we don't have, if you will, equity ownership. There's no ownership of the firm. So, because of that, we can't really use the term equity, so instead we use net assets, but it really means the same things. It means what the university owns free and clear of any obligations to anybody else. The higher that number is, generally speaking, the better, because it means that you have more assets than you have liabilities. So that's the statement of financial position, aka Berman and Knight's balance sheet, which remember, is a snapshot of values as of a point in time, usually the last day of the fiscal year. So let's move on to the second part of the financial statements we're going to look at, the statement of activities, aka the income statement in Berman and Knight's terms. Now this is not a snapshot of values at one point in time, but a way of reflecting the churning nature of financial activity over the course of the year. It is dynamic and not static, and so our visuals here will be in motion, reflecting the aim of the statement of activities to capture the flow of transactions of an entity, money in, money out. Think of it like a sink. Water continually flows from the spigot on top. Those are revenues coming in. But at the same time, it is constantly and continually flowing out of the drain at the bottom. On Monday, let's say, we got a bunch of tuition checks in, but on the same day, we made a bunch of payments for a bunch of purchases that we made. In and out, up and down always. But what is the net effect of this churning over the course of a 12-month period? Now, what are the revenues that come in? Well, they're varied, and they depend upon the nature of the institution. Well, but there's always, say, tuition. Students and parents have to pay for the education students get. Also, colleges get revenues from room charges from students who live in college residence halls. Also, colleges get revenues from board charges from students in meal plans. Also, colleges get revenues from government or business for research programs that they're undertaking. Now, there are many, many other kinds of revenues, but that gives you a start for the kinds of things that would be reflected here on the revenue side. Well, what about expenses? Well, again, this is the money that's flowing out of the drain day by day, and every day that goes by, you're making more payments out. These two vary by institution. You'll always find things like salary and benefits for faculty, salary and benefits for staff, and many other expense items, and we'll get to them as we read a little bit later. But what do we do with this information when we get it all, revenues and expenses? We do effectively the same thing we did, the same A minus B equals C that we did on the statement of activities side. Just there, we tallied up values in the balance sheet and compared assets and liabilities. Here we tally up revenues on the one side and expenses on the other. And what do we end up with? Well, the formula here is straightforward and simple too. Revenues minus expenses equals net revenues, or if you like, net income. Same thing. Now again, in the for-profit world, this would be one measure of a very familiar word to you all, profitability. Revenues over expenses in a business context is one way of thinking about profitability. But again, yes, there are for-profit colleges that are out there, but this exercise is looking at nonprofit and governmental colleges, and we do not have a profit in that world. We can have a surplus, but we can't have that term, technical term, which is only used in businesses, of profit. But we do and can and should have surpluses in the nonprofit and governmental higher education realm. it's just a good idea to do, because while the purposes of nonprofit colleges is not to make money, they need to cover their costs, or better, if they choose to remain viable. So what the statement of activities looks to is to compare the filling of the sink with the draining of the sink, and to tell us over that 12-month period whether we lost money or made money. But here's the interesting part. Remember, the statement of activities is the dynamic one, the one that concerns itself with flows, and the statement of the balance sheet is the one that is static and concerns itself with values. But at the end of the year, in the dynamic statement of activities, there may be a surplus left over. Now we take our camera out again and we do a snapshot of that surplus. We go back to snapshot mode, because the surplus at that point is now an asset of the institution that it did not have before. That is to say, because from our operations we actually generated a surplus, we now can use that surplus at the end of the year as an increase in our net assets. So we go back to the statement of activities. As a result of the positive financial operations that came from the churning, the static statement of activities will look better, as there will be a higher level of assets able to be reflected. So the two aspects of the financial statements, the static and the dynamic, relate to one another. Now, accountants love this stuff, since they can look at all the statements and they can see them all tied together in some sort of harmonic convergence, which they love, a kind of circle of life. All right, that's a bit rich. But accountants do appreciate how one can look at both statements, see how they tie into one another, and use those insights to understand a lot about what makes a place tick. Does it have enough money to pay the bills? Is it getting richer or poorer over time? Does it make money from operations or lose money from operations? So even though accounting looks back, the insights gleaned from an accounting worldview are useful in considering both current condition and future direction. This is the circle of accounting life.